Welcome to today's Explainer. We're breaking down a major global macro and equity strategy report dated July 20, 2026. Let's just jump right into the data, because right now, global financial markets are locked in a massive systemic conflict. We're looking at a pure mathematical collision. On one side, you have the AI capital expenditure mirage, this seductive promise of infinite growth, and on the other, the heavy, inescapable gravity of long-term high interest rates. It's a brutal structural reality check, and today we're going to deconstruct exactly how this is tearing through different asset classes. Here is our clinical roadmap for today's data deconstruction. We'll start with the macro fundamental collision, move into the global liquidity ecosystem collapse, and then dissect the equity market microstructure. After that, we'll map out sector rotation strategy, lay down strict institutional action scenarios, and wrap up with the final verdict. Part 1, Macro Fundamental Collision. We're seeing a massive paradigm shift from bad is good to bad is bad. What is truly fascinating right now is the sheer psychological pivot dominating market microstructure. We all remember the old paradigm, right? The whole bad is good era. If economic data came in weak, the market actually rallied because everyone just assumed the Fed would swoop in with rate cuts. But the data tells us we've officially crossed into a bad is bad reality. Investors are no longer pricing in a central bank rescue. Instead, they're waking up to the fact that weak data actually means genuine demand destruction and a brutal margin squeeze for businesses. So let's look at the cold, hard numbers driving this shift. Headline CPI has slowed to 3.5% year over year, and core CPI has rapidly cooled down to 2.6%. But here's the kicker. Core retail sales actually dropped 0.2% month over month. We're witnessing a simultaneous slowdown in both inflation and consumption. Middle and lower income households are completely exhausted. Credit card delinquencies and bankruptcies are surging. But because the massive energy demands required to build out all this AI infrastructure are creating a sticky spillover inflation effect, the Fed is essentially trapped. They're likely forced to keep rates absolutely on hold until 2027. It creates a structural ceiling that's taking a massive cumulative toll on the broader economy. Part 2, Global Liquidity Ecosystem Collapse. Let's break down the mechanics of the crowding out effect. To really understand what's happening, we need to strip away all the surface-level equity noise and examine the market's actual oxygen supply. We have to define two critical liquidity valves. First, there's the overnight reverse repo, or the ONRRP. You can think of this as the financial system's absolute liquidity buffer. It's essentially a shock absorber. Second is the TGA, the Treasury General Account, which acts like a giant sponge absorbing cash out of the system. The mechanical relationship between these two completely dictates the flow of global capital. Right now, this dynamic is revealing a pretty terrifying liquidity vacuum. The TGA balance has absolutely exploded, up over 163% year over year, hurtling straight toward the $1 trillion mark. It's basically acting like a black hole sucking up market liquidity. Meanwhile, the overnight reverse repo, our traditional safety net, has been drained down to just $100 million. That's absolute zero in this context. The buffer is completely gone, which means any new Treasury issuance is going to violently squeeze bank reserves and trigger a toxic crowding out effect. Because of that, the single most crucial number for any portfolio right now is 2.847%. That is the current real yield on 30-year Treasury inflation-protected securities. This rate is the fundamental bedrock of asset pricing models. When a 30-year real yield is anchored this high, it applies a massive, punishing discount rate to the future cash flows of long-duration tech stocks. Honestly, it doesn't matter how revolutionary AI is. A 2.87% real yield mathematically forces a mechanical, undeniable contraction of stock valuations. Moving to Part 3, Equity Market Microstructure. We're looking at mechanistic breakdown and extreme concentration risk. We really have to address the concentration risk here. This entire market rally has been resting on the shoulders of just a few big tech players, but that monopoly is starting to crack. U.S. hyperscalers have committed to over $1.16 trillion in AI capital expenditures. But here's the problem. The sudden emergence of ultra-low-cost, high-performance models like China's Kimi K3 has utterly destroyed computing costs by a factor of 137. That kind of cost destruction mathematically shatters the expected return on investment for that massive $1.16 trillion spend. It gives a very strict, fundamental justification for a severe derating of these major tech stocks. And it's critical to understand that the selling pressure isn't just fundamental anymore, it's highly mechanical. The S&P 500 has plunged below some critical option market thresholds, specifically the delta flip at 7,600 and the gamma flip at 7,510. When the index crashes through those lines, market makers get caught in what's known as a short gamma trap. To keep their own portfolios neutral, their algorithms are quite literally forced to blindly sell into a falling market, completely ignoring the underlying fundamentals of the companies themselves. Let's expose the hidden derivative risk this creates. If you just glance at the headline VIX, it looks incredibly calm, sitting at 18.10. But when you look deeper, the one-month implied volatility specifically for semiconductors is running at a massive 59%. That is a staggering 44-point spread. So while the headline index projects this false sense of calm, right beneath the surface, derivative positioning is basically a ticking time bomb of explosive volatility.
Part 4. Sector Rotation Strategy. Let's track exactly where the smart money is flowing.
So, given all this brutal math, how are institutional fund managers actually repositioning? The smart money rotation is incredibly clear. Tech and consumer discretionary are bleeding massive outflows, driven by those AI Capex doubts and that mechanical ETF selling we just talked about. Conversely, capital is aggressively flooding into defensive sectors with visible, reliable yields, specifically utilities, healthcare, and financials. This is a textbook risk parity rebalancing act. Institutions are running for cover, hiding in assets that offer thick, defensive margin cushions. But don't mistake this for blind buying. Even within those winning sectors, institutional allocation is ruthlessly strict. Take financials, for example. The smart money is completely avoiding Goldman Sachs, pricing it as overvalued with a price-to-book ratio of 2.7x and rising internal costs. Instead, they are hunting for alpha in names like Citigroup and Bank of America. The logic is simple. Those banks offer a much safer margin cushion, trading at price-to-book ratios between 1.2 and 1.6x, all while showing strong fee revenue recovery. It's a highly clinical valuation-bound rotation. If you want undeniable proof of just how defensive institutions have become, you only need one metric. Prime brokerage net leverage has violently plunged to the 11th percentile for the year. This is not a minor portfolio tweak. This is aggressive, broad-based institutional risk-off behavior. The big players are ruthlessly cutting their market exposure. Which brings us to Part 5, Institutional Action Scenarios, the strict binary portfolio execution. Right now, fund managers are operating on strict binary execution plans. Let's evaluate the two scenarios. Scenario A is the bullish reversal. For this to materialize, upcoming big tech earnings must prove actual free cash flow defense to justify their astronomical AI spending. On top of that, we'd need to see PCE, the core personal consumption expenditures inflation metric, drop, and the S&P would need to convincingly break back above that 7,600 option threshold. Now, scenario B is the bearish breakdown. This triggers the second big tech lowers its investment guidance. If the S&P falls below 7,400, it sets off an avalanche of mechanical, forced deleveraging. If that 7,400 bearish threshold breaks, institutional managers are advised to execute 3 exact percentage shifts immediately. Step 1, brutally cut speculative hardware momentum positions to under 5%. Step 2, overweight agency residential mortgage-backed securities to 25% to completely sidestep the looming corporate bond supply glut. And Step 3, shift 20% of the portfolio directly into 6-month jumbo CDs and money market funds to lock in those real yields. It is a very strict, immediate pivot to ultra-short duration hedging. We also have to map out the black swan tail risk that the market is dangerously ignoring. Imagine this sequence of events. The Treasury General Account hits $1 trillion, massively draining bank reserves. At the exact same time, a geopolitical conflict blocks the Strait of Hormuz, causing oil to violently spike above $100 a barrel. That is a pure stagflationary shock. The Fed is suddenly forced to hike rates. But remember, that reverse repo liquidity buffer we discussed earlier is already sitting at absolute zero. The mathematical result? A complete system paralysis of the Treasury and corporate repo markets, total liquidity arrest. Finally, Part 6, the final verdict, a cautiously bearish posture. So let's synthesize the ultimate institutional takeaway from today's analysis. The final rating is unequivocally cautiously bearish. The seductive narrative of infinite AI expansion is finally crashing into the harsh mathematical reality of capital costs. But everything, and I mean everything, hinges on one singular catalyst tomorrow: Alphabet's Q2 Capex guidance and free cash flow ratio. That single metric will prove whether this massive infrastructure spend can actually generate real ROI. If we see even a hint of margin deterioration or investment cuts in that report, the global valuation defense line completely collapses. And that brings us to a final, critical axiom from the strategy report. The dot-com bubble's collapse wasn't a technology failure, but a failure of the cost of capital. The current market is dancing on a skeleton of mechanical liquidity. Let that sink in. When asset prices totally escape the gravity of fundamentals, a systemic liquidity vacuum will always enforce the harshest kind of valuation reset. Survival in this market structure isn't about blind buying anymore. It's about a cold, calculated retreat into defensive assets. So, what do you think? Will big tech's numbers tomorrow defy mathematical gravity, or will the liquidity skeleton finally snap? Thanks for joining me for this explainer, and remember to always watch the data.